What I think we as an industry have to do is just be grown-ups and adjust to the new reality. There's going to be economic pivots. PPA rates are going to have to probably be higher, but we've done that. We've had far bigger hiccups in the industry or challenges that we've dealt with and overcome.
Corporate demand for renewables and the urgency of fighting climate change fueled a decade of meteoric growth in clean energy. But the facilitator of that surge, cheap capital, has all but disappeared. Inflation, high interest rates, and insufficient tax equity now call into question whether the growth trajectory can continue. I'm John Engel, Editor-in-Chief of Renewable Energy World. This week on Factor This, I'm joined by Tom Byrne, CEO of Clean Capital, a clean energy financier, developer, and asset owner. Byrne shares how Clean Capital is navigating a new normal in clean energy capital markets and breaks down the impact of macroeconomic headwinds on the speed of the energy transition. That's all next on Factor This from Renewable Energy World. Thanks so much for joining the Factor This podcast. Great to see you.
Great to be here, John. Thanks for having me.
Yeah, of course. And I wanted to have this conversation with you, and we've had some Clean Capital people through the podcast circle before, but big fan of what you guys have been doing. Watching you closely ever since I started covering the space, and looking forward to lean into your background and expertise, both on the finance and development fronts as you guys scale what is a really awesome portfolio of projects there at Clean Capital. So plenty to chew on, especially amid this backdrop of macroeconomic headwinds and portfolios getting paused and tax equity mess, all of that stuff. So I appreciate you for jumping on. And this is also one of our first episodes. It's probably the second episode that we'll publish since RE Plus, which I was describing to someone on your team as chaotic. That was my account. Successful, but like very tough to grapple with in the moment. What was your takeaway?
I've used the word hectic often.
Mm-hmm.
I think that's almost synonymous with chaotic. I was at the former SPI back in like 2010, whenever it first started, or
with
like the second
five of
year.
Your best friends.
Yeah, and I think I remember someone saying it was 500 people, and it dwarfed in comparison to the wind conference, WIA, the old wind power conference. And I think I heard there was 40,000 people registered for this one. So quite a change in the industry.
Yeah, it was crazy. And I think by the time you and I met at the show, I can't remember if it was the first day or second day, but we both kind of gave off a haggard persona. At least that's how I'll describe myself. Maybe that's not fair to cast onto you, but you seemed a little burnt on your end too.
Yeah, I was exhausted. I just felt like I kept walking from Caesar's Palace to the Venetian and back, and just logging a lot of steps. That's my recollection.
Couldn't find any water. You were thirsty the whole time.
I was dying. Yeah, thought I just ran a marathon.
Big critique of the PR team. No water. No, I'm just kidding. It's not their fault. That's just kind of a feature of these conferences. Before we get into it, we'll talk a little bit more about RE Plus and some of your takeaways and the conversations that you were having there. But can you start off with a bit of your background and kind of this original thesis behind Clean Capital for those who aren't familiar?
Sure. Clean Capital started in 2016. Was when we really hit the ground running. I had been practicing law in project finance, renewable energy project finance at Chadbourne and Park and Aiken Gump, and then I moved in-house with True Green Capital in somewhere around 2012 or 2013. And then left there to start Clean Capital. And the thesis originally, so there's the original thesis, which was that we wanted to get more participation from in the investor world, high net worth individuals, to invest in clean energy assets. And we actually had a crowdfunding platform that we utilized to actually fund our first deal. And what we learned from that was that was really a challenging business model. It's very difficult to get very small dollars from a whole bunch of people and make them happy. It's a difficult way to raise money. But that initial deal was debt financed by John Hancock. So we got all this equity that we raised online, and then John Hancock actually did the debt on it. And our counterparts at John Hancock at the time said, it'd be a lot easier if you just took big checks from big institutions to fund the business.
Like us.
And we, yeah, exactly. And which we didn't do at that point, but fast forward 5 years later, that's actually what we did. But what we focused on, so that was how we raised capital. But the segment of the market we focused on was small scale assets, C&I, mush, behind the meter. We thought it was an interest, and even more specifically on operating assets. So all the assets that were built during the relatively nascent solar industry from 2011 to 2015, our thesis was, let's go get them post recapture of tax equity, buy them, bundle them up, buy them up, and bring in our investors. And that was what we, those were the two little nuggets of how we of the thesis that we originally started with.
So what has changed the most then in the focus since then to, fast forward a good decade later? So
let me start with where we are now, and then I'll tell you why we got there. We now invest in solar, storage, utility scale, behind the meter, mush, really a wide spectrum of asset classes within the broad solar and storage market. And we also invest in developers. So we fund overhead of developers and then fund their development costs, their pipeline. And I would venture to say that by the end of 2024, at least 75 to 80% of the deals we do will be through that path. We still acquire deals as a financier and then ultimately an owner. We ultimately own and operate them. So they come on our balance sheet. The reason we did that was we were effectively an acquisition company to start. It was all off balance sheet capital from our capital partners at the time. And we would acquire these small scale projects and portfolios. And that was a really good run for a few years. And then the market just started, more players started coming into the market. Returns started going down, and competition started going up. So we knew we had to diversify. So by 2020, we started funding at construction projects. And then that segment of the market, we actually found to be even more competitive than operating assets. And finally, in 2021, we said we need to control our own destiny. We need to develop our own assets. We need to invest in developers that are funding projects that in our pipeline. And so that's where we've headed. And that control also means you have more quality. You have more. You're picking the panels. You're picking the inverters. You're doing all that work. So it also leads to better quality control as well.
So are you guys financing developers through both growth and debt? Which piece are you taking?
We're equity.
Okay.
We are an equity investor. We have a couple of happenstance debt products out there to different developers, but that is the exception rather than the rule. What we like to do is come up with, invest in a developer, come up with an economic partnership that's really good for them, really good for us, and then just fund it. And then so they don't have to worry about anything else. We're the capital behind them. They do what they do really well, which is develop deals. They don't have to worry about their SG&A. They don't have to worry. A lot of developers take unnecessary risk in our view. Don't take salaries, things like that, to get their projects built. And what we say is like, you should take a salary so you can sleep at night and actually do the job you're really built to do. Yes, exactly.
Not being able to achieve interconnection because you can't eat.
Yes, having experienced that for a year when we launched Clean Capital, I actually think it's the wrong thing for entrepreneurs or developers, whatever, to do, which is to have them starve to survive.
So why do you think this model then works to achieve these goals that you have? You're unique in being the developer, the asset owner, the investor financier. You kind of play in a bunch of different sandboxes. Does that ever get overly complicated, or kind of how do you manage that chaos, so to speak?
It's not chaotic. It's actually streamlined. The entirety of there's a vertical integration concept behind it, right? Like we're kind of at every stage of the project, right through operations. Think how many times a project used to trade hands by the time someone ultimately owned it. So some developer would flip it probably mid-development and then flip it again at NTP. NTP might even flip it at COD to someone who's more comfortable operating it. And then the old school clean capital would buy it after 5 years, right? So there's a lot of points in friction, points in cost in that. So everyone is getting their returns impaired. And then also the off takers are having to pay more to support all of those economics along the way. And the quality control, I get back to that, is not the same. The initial developer would just want to flip halfway through development. So now that vertical integration, while there is different skill sets along it, actually creates a better product for all constituents that are involved in a particular project.
One of the most popular episodes that we've done on this podcast, now probably a year ago, was called What's Going On in Clean Energy Capital Markets. And it was kind of just the beginning of, inflation was setting in, tax equity was getting a little, hesitant, and even growth financing seemed to be changing. At least, we didn't really know what was coming, but it's all picked up and gotten a lot harder in the last year.
Yeah.
And so I do want to use this as an opportunity to kind of revisit that core topic of like analyzing the capital stack and where we sit today, because you, as I mentioned, have a really unique perspective into each of these different verticals. So can you kind of help characterize for the audience, where we stand with inflation, interest rates, all of it? What is it doing to developers that you work with who are trying to maintain these portfolios and seemingly trying to grow? Is it putting the brakes on development in a significant way, or just making it more challenging?
There's so many pieces to unpack there. So let's start first with interest rates. There's the coming to Jesus is just now happening, and I would say that's over the last six months. Let's call it. When Chairman Powell started to increase rates, we did not see for a year any change in behavior from buyers or sellers, and we saw sellers still expecting the same exact development fee or purchase price, acquisition price, and buyers were keeping the same return expectations. I think that has fundamentally changed over the last 6 months. Now, people are realizing that the returns, that the levered returns, which is how we often measure returns in our business, how much is predicated on the cost of debt. And if your leverage costs more, then your unlevered returns need to be higher to support your same return goals. Let's say you want a 10% or a 12% return. To get there in today's debt markets, it has to be a higher unlevered price. So what does that mean to the developer? We can't pay you as much. Or to the seller of a project, we can't pay you as much as we used to be able to pay to satisfy our returns. Another piece of that puzzle, which is related, is that the return expectations on an unlevered basis for institutions, insurance companies, pension funds, probably sovereigns, I would expect, anyone who's the ultimate equity in the capital stack is higher. I had a lunch at RE Plus with a large pension fund, and the gentleman I was speaking with said, back in the lower debt rates, we would accept a 7% unlevered return, and we wouldn't want to put any leverage on our portfolio. This was a particular pension. And he said, how can I go back to my credit committee at my pension fund and take a 7% unlevered return on a solar asset that necessarily has volatility and variability and uncertainty in its operations, and I could get a 6.5% to 7% on on corporate bonds from a creditworthy counterparty that is close to a guaranteed yield. So this has been a massive macro shift. It's good news that people are now coming to terms with it. It even took us a while at Clean Capital to come to terms with it, but we saw it. We were losing deal after deal after deal after deal after deal, and wondering how the heck people were paying the prices they were continuing to pay in this debt market. But we're starting to see that change.
So are you seeing developers take a haircut on just their expectations, or are they waiting and trying to just weather the storm? Like, has it limited deal flow at all?
I don't think the only limitation on deal flow that I've noticeably seen is when there is a power contract, a power purchase agreement that is fixed and it's markedly lower than what today's new economic reality can support. So if you're entering into a power contract with a utility at a low rate, you're probably not going to build it. Unfortunately, getting the hopes up of the utility that they're going to be able to buy power for super cheap. We signed PPAs 6 months ago that we were very happy with. And now the prices in those markets have gone up $5 to $10 per megawatt hour on those PPAs. So like what we thought was good is now just okay, because PPAs need to be higher to support the higher cost of building projects and the higher debt rates.
So what happens to those projects, at least how you're approaching them? Are you just going forward and saying, it is what it is and conditions changed and we just need to keep pushing, or do you pull back?
Those particular projects, the PPA rates were good enough that they still support sound economics for our project, but we are looking at the expenses of the project, both construction and operating expenses, and trying to find value, shave expenses wherever we can. But those still stand on their own. I think there are a lot of projects that fit that will not stand on their own any longer, though.
Is this just a near-term issue, or are you expecting this to extend, the next couple or few years?
I don't know. I think guessing rates or guessing where the debt markets go is not my expertise, and I've found that it's not the expertise of the experts on TV either, because they all have something different to say. But I personally think we are in a new normal, whether the rates come down a little bit, if there's some sort of slowdown in the economy, I could see that happen. A lot of folks forecast that. I don't know that the days of really low rates, 3% debt, are coming back anytime soon, and I don't know that we want them to, because that would mean there's some broader bad thing that happens in the economy, and yeah. I don't think anyone should wish that to happen.
So how do you position Clean Capital then to adjust to that new normal? I'm sure it was an advantageous move to, staff up your in-house development team, now not having to take on the returns of people throughout the value chain and the kind of middlemen developers who are flipping assets.
Yeah, we've got that, I believe, was a good strategic pivot that we made in 2021, and it wasn't made because of rates or even costs, which have obviously still gone up. That was a pivot we made just to be more in control of our own pipeline, but it is fortuitous, because we are now able to withstand the big shifts in the macro environment that are happening. The other thing that people are doing is that's debt markets focused is I think looking to shorter term debt. So no one wants to lock in rates today. So talking to your banker, your lender, and figuring out ways to have shorter term debt on projects, even if it means you take less debt on the projects, is something that we're seeing, hearing, and we're even talking to our lenders about as well.
How about the demand you're seeing from developers coming to you with projects saying, like, we need to get these off our own balance sheet because of the market conditions that exist, that maybe they raced too quickly to transition from developer to IPP, something we've seen a lot in the space over the last couple of years, and now are overexposed and suffering, cash flow issues. Are you seeing that? Are you getting more traffic from developers looking to partner with you?
We're getting traction from developers because I think they like what we're providing, not because they're trying to offload assets. The one observation that I have seen as folks adjust to the new normal is we've seen more deals come back to us that we lost on over the last, call it 6 or 12 months. We would, in a typical auction or transaction, we would bid on a project or a portfolio, we would lose
due to an outlier being,
yeah, probably more than one outlier in many instances.
Yeah.
And then we moved on with our lives, and we are now seeing a lot more deals than normal come back to us through that type of process. So I think that is also a good metric or a good anecdote that's showing where things have changed.
I talked about that with the CEO of Standard Solar in the episode that publishes before this one, and we talked about the muck of projects, like the bad assets that are out there, the ones that change hands multiple times, that were that race to the bottom on bids. And I asked Scott about, how much muck is out there, and like what's the spread between good available projects that are coming to you and the bad ones. And he said, there's a lot of muck.
I don't know if I agree totally. I think we are such a better industry right now. The industry was riddled with muck 5 years ago, and it was exclusively muck 10 years ago. So there's still plenty of assets that are of a lower quality that people are trying to offload, but it's tougher to get away with that now than previously, because the industry is just much more mature. So I agree with him to some extent, but I don't think it's quite as bad as perhaps you and Scott thought.
Not you. I'm not the developer here. I just put questions on a pedestal and let you guys take them. Do I sometimes try to, twist a little bit and see if I can get a word like muck into a quote? Yeah, maybe. But that's my job, not yours. I think
I used it 3 times.
Yeah, I appreciate that. I'll clip it for sure. I appreciate that rebuttal, and maybe I'll have to send it back to him too to see what he thinks. But okay, so then what does it all mean is, I guess, the next question, especially for some of the smaller and mid-tier development shops. Do you forecast like further consolidation in the market? Do you see, again, like the offloading of assets, just not being able to sustain this high rate, environment, given that money was essentially free for a long time? What does it all come down to?
Well, we have to remember that with the passage of IRA, that we have massive tailwinds. There are, in the United States, I don't know what the latest count is, but of how many states have 100% RPSs, clean energy standards. We have the most fulsome policy support from the federal government in the IRA. So generally speaking, the macro tailwinds are firmly behind the industry, and I don't expect that to change. What I think we as an industry have to do is just be grown-ups and adjust to the new reality. That means there's going to be economic pivots throughout the industry. Returns are going to get adjusted. PPA rates are going to have to probably be higher. There might have to be some expense, some of the partners shaving expenses to make deals work. But we've done that. We've had far bigger hiccups in the industry or challenges that we've dealt with and overcome. So I'm not concerned like at a macro level. On specifics, consolidation is one of the ways that you deal with higher expenses theoretically. And consolidation also includes kind of how we've morphed as a company. While we didn't consolidate, we did make an acquisition of BQ Energy last year, but we're not focused on consolidation right now. But we are consolidating the life cycle of a solar asset. We now develop. All right, we didn't. If you told me we were developing assets in 2016, I would have said no. That's not even how the business runs. But there's been some what I would maybe call horizontal consolidation amongst companies, and our peers have many of them have done the same. That does. When I look at our peers, I do think there's a lot of good companies doing things that are similar to us, so that necessarily invites conversation about consolidation. And a lot of us who have gotten to a certain size and scale, that we're high quality companies of a good scale, so that does lend itself to some sort of consolidation. And I've heard that from advisors and experts, but I think that's more, the consolidation is more from the perspective of the maturing of a lot of businesses than it is from the perspective of managing the costs and the rates adjustments.
So are you guys exploring further M&A beyond the BQ transaction, or is that something that just wouldn't be in the cards right now?
We're open to it. We invest in developers, so in some ways that's a quasi acquisition, right? Because we take equity interests in those companies and then fund them on an ongoing basis. We'll do that. We're probably going to make a couple more announcements in Q4 on that front, and we'll continue to do that into 2024. We will only do a more broad acquisition like BQ if it makes a lot of sense for where we're going as a company. And in the case of BQ, who is best in business developers, particularly on landfills and brownfields, that just made so much sense for us. So it has to be very complementary to where we want to get to as a company.
All right. How about tax equity? What the hell's going on there?
What the hell is going on there? There's not going to be enough tax equity from the traditional tax equity players to fund the market, to finance the build out over the next 5 years. So I've been very focused on transferability myself, because I think that, I hope, is a new market that brings new entrants into the market. We've every time we've done a deal, it's always like, where are we going to get tax equity from? It always seems like a strain. And I would imagine most of our peers feel the same way, particularly on these smaller assets. So when you couple that how difficult it always has been, with the fact that I think there's going to be just so much more built in the next 5 to 10 years, something fundamental has to change. I keep saying that all these corporates who tout ESG and climate initiatives, and they just have massive profits, how they are sitting on the sidelines of the tax equity market is bewildering to me. They should be the ones who, if they want to really do something meaningful, get a tax equity desk built up. Apple has $100 billion of I don't even know. It's a massive number. It could fund the entire industry. The tax appetite of the entire industry. And I'm like, why have they not done more? And Apple is just one example. There's plenty of other super profitable companies in Silicon Valley that could do the same.
Well, you deal with a lot of corporates, though. I mean, your corporate offtake agreements are what has fueled this industry for the last decade. So do you bring that up? You're like, hey, this deal is great, but you know how to make your money work even harder, for this cause?
Yeah, we have brought it up. It seems like there's and I think actually in a couple of cases we'll get some folks over the finish line. And I think transferability, I'm hoping, actually makes that a little bit easier, a little more simplified. But a lot of times you also hear how challenging it is. That's not what they do. And I think it's just this perception of complexity that's kept folks out. Because God knows the returns for tax equity investors from an IRR perspective are really healthy. So I don't see why folks wouldn't want to get involved.
Interesting. Okay. Well, it sounds like something definitely needs to change if we are to reach any of these, lofty targets that we have. So on transferability, have you gone down that road with any projects yet? I know it's still a relatively new concept, but I've spoken to a number of developers who are trying to pull those together.
We have not. I suspect we will as the market matures a little bit. We never want to be at Clean Capital the first movers to anything. We like someone else to test the waters, and then we like to be fast followers.
Because you're a
So we haven't done it
lawyer.
yet.
You're a lawyer and a financier.
Yeah, exactly. So we haven't done it yet. I bet we do it sometime in 2024. It just makes tons of sense for particular types of projects as well. Some that the tax equity market may not be as favored towards.
One of the reasons I wanted to have you on the podcast after meeting you at RE Plus is I take you as a very candid and forthcoming person that will shoot you straight and kind of tell you what's going on. What are some of the things that you pull out from the conference based on the conversations you had? I appreciate the anecdote with the hedge fund manager, or pension fund manager, whoever it was. Anything else that kind of stuck out to you as I wasn't expecting that, or was interesting in one way or the other?
Yeah, I think a few things. One, the conversation or the acceptance of the rates being higher and returns needing to, and the corresponding impact on developers, and how I spoke to a million developers at RE Plus, and they said it before I even said it, right? So that was in some ways a breath of fresh air, because we're now all playing from the same level playing field with the same facts. The other anecdote is that I think we need to do better as an industry to have conferences at places that are not sapping water and energy and creating and sapping energy in the middle of the desert. That to me is, I thought we lost an opportunity to really shine a light on climate, even if it isn't going to be, if it is going to be in Vegas. I think we need to, as an industry, do a much better job of making these conferences also about climate. And I felt like we missed a real opportunity in Vegas in particular. Other than that, I think the conference I think we're a big industry now, and it's not niche anymore. There were so many people from oil and gas at that conference.
Oh, really?
Be like transplants, like people who I used to work in oil and gas. And I find that that to be refreshing. That we're now, I think, on the cusp here of really being, the primary energy source, the primary energy industry. Solar and batteries.
Well, and the CEO of Renewable IPP, one of your partner companies there in Alaska, it came from an oil and gas engineering background, I believe, right?
Yes. The CEO and the president of Renewable IPP, which is a developer we're invested in, are both transplants from the oil and gas industry. So is the construction workers that they hire to build their solar projects in Alaska.
Yeah. It's cool, and I wish I could remember her name because I'm blanking on it now. But she's been on this podcast.
Jen Miller.
Jen Miller was
superstar.
Probably 30 or 40 episodes ago. So I think I deserve a break on that one. But yeah, she was great, yeah. And please go check it out, because I think they're doing some really, really cool and interesting things in a market that is not an easy place to play for solar, but Alaska.
Yeah, exactly. Yes.
Something I ask everyone that comes on this show: what keeps you up at night now? I mean, it seems like you guys have a firm grasp on where the market is and what your goals are, but what's that kind of lingering thing that just bugs the hell out of you that you're still trying to figure out?
Yeah, as a CEO of a company, a lot of things keep me up at night, both internal to the company and external to the industry. So I don't think you're doing your job if you're not having a couple of sleepless nights. I think, the thing that I'm most eager to see over the next 2 or 3 years is the integration. This might sound like an obvious answer, but learning how batteries and electric vehicles, maybe over the next 5 years, get integrated into the grid, into the American landscape, but then just as importantly, how they're viewed through the investor lens. Investors will do solar all day, every night. Institutional investors, pensions, insurance companies. Not many do batteries yet. They still find it skittish. Still don't understand how to make money on it. still has too much risk. And then EV infrastructure as sort of a tangent to both of solar and batteries is an even farther afield segment that needs to be financed. So I it, we're doing a lot of batteries at Clean Capital in our development pipeline, hundreds and hundreds of megawatts of batteries in our pipeline. And I don't know how the institutional market is going to receive it. I don't know how the tax equity market is going to receive it. And even the debt markets, how they're going to receive it. So that's something that has to be reconciled, and it will be reconciled. But there's still a lot of uncertainty that looms there.
So that's still happening with storage. Hasn't it gotten
Yes.
hasn't it gotten better over the last couple of years? Just as we're deploying a ton of batteries, but you're still running into that.
There's still there. I would say there's more investors, more of your solar investors that are not ready for batteries than are ready for batteries. It is absolutely better than it was 2 or 3 years ago. That's why it's gonna and it will continue to improve, and people will continue to get comfortable, and it's better than it was a year ago. But it's not there yet.
So why did you guys want to get involved in expanding to storage in the first place?
I think we have to. I think it's an asset class that's going to be so complementary to solar. We view ourselves as investors in the clean energy transition. That's a mission orientation of our company. So we have to invest in asset classes that are part of the clean energy transition. We're very heavy in solar, increasingly active in batteries, and starting to think about other ways that we can participate in EV infrastructure, things like that, where we play, where our capital can go to be useful in the clean energy transition.
So have you started down the road of seeing that, no pun intended, of seeing what your role could be in EV infrastructure? I mean, you mentioned it a couple of times. We're looking at business models right now. It's probably similar to how we kind of started nibbling around batteries. Looking at business models and trying to understand which business models fit into our investment profile and particularly the profile and risk tolerance of our largest shareholders. So we're still in exploratory, but I think we'll head in that direction. There's some really cool business models that are more risk appropriate for us in the EV infrastructure space that I get excited about. And I think the more I think we'll get there at some point in the not too distant future. I gave you the opportunity there to say you're going into green hydrogen, and you didn't do it. So
no,
I appreciate that. Everyone's an IPP. Everyone's vertically integrated, and everyone's doing hydrogen. That's
we're not doing hydrogen, but we are. I'm sorry, we are sort of like a growth oriented IPP.
Yeah,
but we were one of the first ones. We did that in 2021, which is many moons ago at this point.
Yeah, it does feel like a long time ago. That is funny. Given your conversations at the show and just with investors in general, how would you gauge, just overall investor sentiment to the space? Given everything that's going on, is it still positive and moving in the right direction?
It's still a great space. If you're talking about solar alone, it's still asset to invest in. If you're an investor and that's your infrastructure play, it's a great investment. It's a hard asset, generates relatively predictable revenue. The expenses are relatively predictable, and it will last for a long, long time, longer than we underwrite it for. The only thing that's changed is that the return expectations are a little bit different because the market's changed, and that's okay. And we're making that adjustment in the industry. But as an asset class, I think people, institutional investors, who have been on the sidelines for a long time are still eager to get in, but at the right risk reward.
Yeah. What excites you most about what you're doing now? What's kind of that next vision for you and Clean Capital?
So what excites me is I was very excited at RE Plus where we've come as a company, and this is going to sound almost like CEO speak, but the people that we have attracted at Clean Capital are high caliber, high quality, mission oriented people. My colleagues. So And when I go to RE Plus and we expose, and many people get exposed to my colleagues, I think that rubs off for sure. So I'm very excited about our company and where we are and our opportunity to be a leading investor in this space. I'm excited that um, that our industry has taken hold, and that even if we are behind on the build out goals, either state by state or as a country, we are moving markedly in the right direction. And I don't know that people would have said that 5 or 6 years ago. Like the destiny is known. Um, the time that we get there, when we get there, is not guaranteed. But I think there's a hunch and agreement that we're getting there. That clean energy is being built out in this country. That batteries are going to deal with some of the challenges of intermittency, and that we will ultimately get to a place where we are, dare I say, 100% renewable, 100% clean.
Well, I love the path you guys are taking and what you're doing to try to get us there. And to the point about your team, you do have a great team. I can vouch for that. And the industry speaks very highly of you, Tom, and John, and your whole kind of executive team. So I think kudos to you guys for putting it all together. Tom Byrne, thanks so much for joining the podcast.
It's awesome, John. Thank you.
Thanks again to Tom Byrne for joining the podcast. Factor This is a production of Renewable Energy World and Clarion Energy. Join us every Monday as we break down solar's biggest stories with industry leaders who actually move the needle. And please leave us a rating and review wherever you get your podcasts. Thanks for listening, and we'll see you next time on Factor This from Renewable Energy World.